what we're going to be going over here is a deferred tax liability. This is where we're going to have a future taxable amount with changes in our future tax rates here, and we're going to be using the enacted tax rate here to account for this deferred tax liability. So let's go and look at our example here, and we're going to look at it from the tax accounting perspective here. We're going to be looking at year X1 here. We're going to look at the beginning of the year here and at the end of the year here, year X1 here. And this is where we're going to have a temporary difference that's going to result in a future taxable amount. And we want to, this temporary difference here is going to reverse itself in the years here, year X2 and year X3. But let's start with year X1 here. So what I'm showing here is everything is in thousands of dollars. So we start out with this temporary difference here. Let's say it's $1 million here at the beginning of the year here, year X1. And at the end of the year, it's still, we have a temporary difference. It hasn't changed any. It's still sitting at $1 million. And that's the only temporary difference we have. So what we want to do here is we want to determine what our tax payable is first here for this resulting from this temporary difference. So let's look at it first from this perspective here. So we're going to start out with our income before tax here at $2.5 million. Now the temporary difference here, it's not going to affect the our income here before tax, or it's not going to affect our taxable income here, because what's happened here, the temporary difference from the beginning of the year to the end of the year, there hasn't been any change or any originating difference here during the year here. So what we're looking at is just 1,000 here, comparison, 1,000 versus 1,000, zero difference or originating difference, so it doesn't affect our income, our pre-tax income here. So the pre-tax income here equals our taxable income. So we start out with our income before taxes, or pre-tax income of $2.5 million. That equals our taxable income here of $2.5 million. And we're going to use a 40% tax rate here. That's what we're using here for year X1, that we have the tax rate or for the year here. That's 40% times the $2.5 million. Our tax payable, or our current tax here, is going to be $1 million. Okay, so now we go up here, and we're going to actually, at the end of the year here, the government has enacted a new tax rate. It was sitting at 40%. Now they enacted here at 34%. And that's going to be our new tax rate. And based on that new tax rate, we're going to be looking at the reversal of our temporary difference here. Now remember, the temporary difference, that was that total amount here of $1,000. Or $1 million here at the end of year X1 here, and it's going to reverse itself over the next 2 years here, year X2 and year X3, equal amount each year here, $500,000. So that's going to be our future taxable amount for each of those years here, based on that $1 million temporary difference here at the end of year X1. So what we would do here, we take our temporary difference, the $500,000 here for year X2, times our tax rate of 40%. That's for year X2. That government hasn't changed that. That's what they're stating here for year X2. So 40% of the $500,000 is going to give us a deferred tax liability here of $200,000. And that we're going to classify as our current liability here. Now, moving to year X3, this is where the tax rate has changed here from 40% to 34%. So that's going to change our deferred tax liability and let's look at it here. So we have a temporary difference of $500,000 times the new tax rate here of 34%. That's going to give us a deferred tax liability of $170,000. So our total deferred tax liability is just the sum total of year X2 and year X3, $370,000. So you see what's happened here, and this total deferred tax liability is due to the change in the tax rate. Nothing to do with the liability or the temporary difference. All it has to do is with the change in the tax rate. So this is how you're going to handle that here. So we had a deferred tax liability here of $400,000 here at the end of year X1 here. Now, with the changing of the tax rate and the reversal of that temporary difference, the temporary difference of year X1 reverses over year X2 and year X3 by $500,000 each year here. But it also changes our deferred tax liability here. We had that $200,000 here for year X2, but now because of the change in our tax rate, it's down to $170,000 here in year X3, because it would have been $200,000 had the tax rate remained here at 40%. So now we're sitting with our total tax liability here of $370,000. So how do we account for this here for reporting for our tax accounting here at the end of year X1? Our deferred tax liability, we have on our account here at $400,000. Now it's moved to $370,000. And then the other point we want to make here, deferred tax liability year for year X3, the $170,000 is considered classified as non-current. It's greater than 1 year here, this liability here, so it's non-current. So let's go down and let's look at how we would record this. So we're going to start with our tax payable here. So that's really our current amount here of taxes. So that's what we calculated here up above. 40% of the $2.5 million give us $1 million here for our tax payable here on our balance sheet, $1 million. Now, this is where we're going to have to deal with this change in our tax rate here for our deferred tax liability. Now, this is how we calculate our tax expense here, and we'll look at it first by not considering the change in our tax rate. So we start out here with a beginning balance in our deferred tax liability of $400,000 in year X1 here, and then the total here for year X1 at the end of the year here was $400,000. So we have a net increase of 0 here for the year. So we look at simply the net increase here to determine our tax expense for the year here. So we have a net increase of 0 here. Our tax payable credit of $1 million. So what we need is a balancing amount here, tax expense on our income statement, debit here for $1 million. So that's how we take care of the case here before we have to consider the change in our tax rate. So what we would do here, first off, let's just look at it from our perspective here. So we take our tax payable of $1 million here. Our deferred tax liability, it isn't increased or decreased, it's just the 0 amount here. So our tax expense is $1 million. Okay, so there gives us our tax expense here. Credit, tax payable here of $1 million. Credit here of 0 balances with our tax expense debit amount here of $1 million. Now, let's look at how we take care of this tax change in our tax rate. So again, we look at the deferred tax liability here at the beginning of the year here at year X1, that was $400,000. Now we had to recalculate here for the end of year X1. That was based on that change in our tax rate here. It actually was tax rate changed to 34% here in year X3, and that reduced our deferred tax liability down to $370,000. So we have a net decrease required in our deferred tax liability here. Beginning amount $400,000, now it goes down to $370,000. So what we would do is we just debit or reduce our deferred tax liability by the difference here, $30,000. So reducing our deferred tax liability here by $30,000 for the change in that tax rate also reduces our tax expense on our income statement. We would credit that or reduce that by $30,000. So what was this tax rate, due to the change in our tax rate, the decrease in our deferred tax liability was $30,000. So that reduced our tax expense. So when you're dealing with these changes in tax rates here, you really have to you just have to adjust your deferred tax liability by whatever that change in whatever the effect was for the change in that tax rate. And we were looking at recording it here for actually the end of year X1 here, and we realized, or we were informed here by the government, that our enacted tax rate for year X3 was going to go down to 34%, which reduced our deferred tax liability by $30,000. Okay, so now let's go and let's look at how we'd record this on our income tax expense section, our income statement here for the end of the year here, 20X1. Remember, that's our first year here. So we'd have listed here our income before taxes. That was at $2.5 million. Now we have to break out our income tax expense here. Our current portion was the $1 million based on our tax payable here. But now we would list it here. We'd have an adjustment due to the tax rate. Had nothing to do with the deferred tax liability except the tax rate here affected the deferred tax liability. So that was that $30,000 here of adjustment. So you reduce your current amount here by $30,000. So that's going to give you your income tax expense here at $970,000. So now our income before taxes, $2.5 million, reduced by our income tax expense here of $970,000, gives us our net income for the year at $1,530,000. So this is how we have to take care of this change in our tax rate and how we'd report it as part of our income tax expense section here on our income statement. Again, for year 20X1. So let's just go back and look at it one time again here. So in this case here, we had the case here where we had no change in our temporary difference, which didn't affect our deferred tax liability when you look at it just from the beginning balance here to the end of the year balance here. There was no net increase here because there was no originating difference. All that happened here is our tax rate changed for our temporary difference, the future taxable amount. The tax rate was reduced, so that reduced our deferred tax liability. In this case, it was by $30,000. And by reducing our deferred tax liability, we also reduce our tax expense on our income statement, only due to the tax rate here. No change in the temporary difference, just due to the tax rate. So that's how you're going to record this here for your tax expense here for the year here, and how you handle your deferred tax liability. And also we looked at how you would report it here in your tax expense section here on your income statement, again for the end of the year here 20X1. Okay, so that'll summarize our discussion here on this deferred tax liability where you have a change in the future tax rates.